Could it be that the result of these higher interest rates that just aren't coming down in 2024 is finally going to cause the housing market to crash? Now, there's a lot of speculation around this, but today I want to unpack in this May market update for 2024 what's transpired in the last couple months and where we're at this moment in time. If you guys like this information, it's be super helpful for me so this can get out to more people. If you comment, hit the thumbs up, subscribe. As you know, I do these every single month. More importantly, as I want to keep you guys in the loop as what's happening. There's a lot of unknown, there's a lot of volatility. Quite frankly, the market's a little scary right now, especially if you're interested in potentially getting into real estate. When is the best time to do that? And for me, I look at a lot of the data, and today I'm going to show you guys some information that I've pulled to help keep you in the loop as to where we're at right now and what to project moving forward. So many of you have maybe seen this guy, Jerome Powell. He is our Federal Reserve Chairman. And essentially, they meet every 6 weeks. They meet 8 times a year, and they talk about what the state is of the economy at that time. And, you know, the latest topic has been, you know, that rates are going to remain higher for longer. So what does that really mean? So what we've been watching for the past several months is we want the Federal Reserve to start cutting the federal funds rate. Right? They've been trying to get inflation under control. Think about how expensive everything is right now. Think about how much it is to fill your car up. That is a big part of that is tied to inflation. It was rising so much through the pandemic and towards the latter end of the pandemic. Then we started to see the Fed step in. They started to raise the federal funds rate. They're making things more expensive for us as a consumer, so people stop spending money. And if they do that, then inflation will come down. Now, the result of that is it's been working. Inflation has been dropping. However, in the last couple months, the reports in the end of March and through April, the inflation numbers came out and it was increasing a little bit. So now the scare going into this is the Federal Reserve, now maybe they're going to start increasing the federal funds rate again. This would be horrible for mortgage rates. It would make everything so much more expensive for us. So they met on this week, or their April meeting. By the time you're getting this, it will be early May. And essentially the rhetoric of that was, listen, we understand that inflation ticked up a little bit in the last couple of reports. However, we don't believe that that's moving the needle enough for us to come into a decision where we need to start raising the federal funds rate. So this is a good thing for mortgage rates, especially if you're waiting for them to come down. So the other thing they talked about was their balance sheet. You know, during the pandemic, why interest rates got to 2 and 3% and why we may never see that again is the government stepped in and they bought what's called mortgage-backed securities. These are all related to mortgages. Usually investors are buying this up, and the government came in and bought billions and billions of dollars of mortgage-backed securities to keep our economy strong, to make it possible for those that were buying and refinancing during the pandemic to be able to do so. And it also brought a ton of buyers into the market at those rates that we saw in the 2s and 3s that probably weren't an active buyer at that time based on normal interest rates. 2 and 3% is extremely abnormal, but it did bring a lot of people into the market that normally probably couldn't have bought. So now where are we? They stopped buying mortgage-backed securities. They're going to start letting their balance sheet run off a little bit. And hopefully this is attractive to investors to start buying treasuries and bonds and mortgage-backed securities again. And if they do, we could have some relief to mortgage rates, but we shall see with that. I do believe it will be a rocky road. Let's dive a little deeper into that stuff. So as you see here, I wanted to show you, I went back, and again, I'm going to show you some data, and I think this is going to allow you to make a decision on what is happening and when is the best time for you to get into real estate. So as you can see from this chart, it shows all the different colors represents a 30-year mortgage, a 15-year mortgage, a 30-year FHA loan, and a 30-year jumbo loan. These are all different types of loans, but they really kind of show the same trend more or less. So you can see here it goes back and all the way at the top left there. So I'm just going to look at, I guess this would be considered a burgundy color. This would be just a normal 30-year fixed mortgage. As you can see at the top left there, above 7.5%, we saw in November of 2023, rates hit 8%, and in some cases, a little bit more than 8%. It was the more that we've seen in more than 23 years. After that, we started to see inflation come down a little bit. The Fed decided that they're not raising the federal funds rate. It started to stay flat. This was a good thing for the markets. We started to see interest rates improve. So you can see here in all of these products through December and all the way into January, we saw a nice little dip from about 8% to about in the high 6s. Now, a 1% or more drop in interest rates in a 2-month period, it is a massive drop. Usually interest rates don't move in that manner. It's a little bit slower of a process. It's usually a rocky road, but that was a pretty consistent drop. So we saw a really big spike in real estate and people buying. Just a 1% drop could, drastically change your payment every month to hundreds of dollars a month, depending on how much of a loan that you're qualifying for. So it brought a lot of people back into the market. But look what happened in January. Then you start to see it slowly start to go up again. So the Fed has not raised or cut the federal funds rate, but what they're looking at is our jobs market, inflation, all of those things the reports have come out pretty hot, meaning our economy on paper and what they're looking at is perceived that our economy is very strong right now. Meanwhile, there's a ton of other indicators that would tell you differently, but this is the reports that they're seeing right now. And being that they saw inflation not coming down and that the jobs market was still pretty strong, this is why from January, where we were in the high 6s, and you can see in February, it was kind of a rocky road. It increased to about 7%. We saw a little dip in early February. And then as we get into March and April, we were kind of hovering in the low 7s there for a couple months. But then you're going to see after April and coming into now May, we've seen this pretty steady increase in interest rates from in the low 7s to now we're hovering kind of in the mid 7s and in some cases even closer to 8%. No one had predicted this at the beginning of the year. Many thought that by this time or going into summer that we should see rates in the 6s is what many people forecasted. Rates are going in the opposite manner. So let's dive into this a little bit more. So, one of the other things that we need to keep an eye on, and affordability is a big problem right now, obviously, to buy a house at a price point that many Americans are looking for, when you're making a payment based on an interest rate in the mid 7s, it's expensive. Real estate is expensive. And the reality of that is it's making it difficult or almost impossible for some people to get into the market. However, there are buyers out there that do qualify at those higher interest rates. So while buyer demand has backed off a little bit, one thing that isn't talked about enough is the amount of homes that are available for sale in the United States. We are at an extreme lack of supply, meaning homes available. So if you think about, many say that there's upwards of 3 million buyers that are waiting for interest rates to come down. So I call this pent-up demand. They're all imagine them just sitting in a room. They're just waiting, looking outside, waiting for those interest rates to drop. And as soon as they do, they are going to explode out of that house and they're going to start buying real estate. So one thing we look at here, and I'll pull up this chart. This is inventory, and this is going back to 2019, just to show you how bad this is. So in July of 2019, so this was about a little less than a year, about 9 to 10 months before the pandemic hit in 2020. We were just under 1 million homes available for sale in the entire United States. That was really low at that time. Then the pandemic hit. And you can see here, it drastically dropped, right? Over from 2019 all the way through, obviously the end of 2020. Why did it drop so much? Well, if you remember, interest rates went down to 2, 3, 4% from where they were at about 6% before the pandemic started. So that big of a drop brought a ton of buyers back into the market. They were soaking up all this inventory. So it went from, call it 950,000 homes available for the United States. And at one point in April of 2021, there were about 300,000 homes available in the United States. Guys, we have 330 million people in the United States. And there were only 300,000 homes available for sale. It shows you how little inventory we've had. And we've been suppressed with over the past couple years. One thing I wanted to notice here, you can see here, in about the middle of this, so in about April and July of 2021, you'll start to see like these peaks and valleys. You're going to see it there. You're going to see it again, and around the same time, in about April of 2022, you're going to start to see that inventory pop up. And then you're going to see, roughly in about the fall time, you start to see it come down. So now look at 2023, same thing in April through the summer, you start to see it pick up a little bit. So I want to explain why this is happening. Historically in real estate, the peak buying season is spring and summer. The main reason for that is those that have families and kids are not looking to buy a home or sell their house and move when their kids are in school. So historically, it's always been spring and summer are those peak times. That's when many, depending on where you live, the weather's nicer. It's a good time to sell your house when your house looks good and the weather's nice, opposed to, if it's snowing and cold. So as you can see here, that's why those peaks and valleys were happening. And even with, remember, rates were at 8% in the end of 2023. We still saw during that time buyers coming back in and still buying real estate, even at those higher interest rates. So I just wanted to show you, is this a sign right here that many of these articles are saying that inventory is popping up a lot right now? Is that just because where we are in the time of year, that it's the peak time, spring and summer? Or maybe sellers who are locked into those super low interest rates are maybe considering, I really don't love this house. I don't think rates are ever going to get down to 2 and 3% again. Maybe I'm going to think about selling. So I want to show you this next chart. So this next chart talks about new listings that are coming to the market. So it's a little hard to see. You can see in the top left here, it shows you in 2022, there were 72,000 homes that came onto the market. In 23, only 63,000. And now in 2024, so far, only through a few months, we're at about 70,000. So in the news, they're really highlighting inventory is spiking, inventory is coming up. Remember, even if it's coming up a little bit, we're still extremely low in inventory, but this is a good sign for buyers that inventory is coming up. Now, it's a little bit hard to see here, but essentially the orange and the pink line represent 2023. You can kind of see they moved in the same fashion. Back from 2022, they've kind of plateaued a little bit, like nothing too crazy, but you can see this burgundy line that ends at about now, starting in May of 2024. The trajectory that we're seeing with inventory right now is the same as what we saw in the last couple years. However, it's on the trend to potentially get a little bit more. This is something that we have been waiting for. If you're a buyer in this market, you'll understand this. There just aren't a lot of homes that you like available for sale. Many people that do financially qualify these higher rates want to buy. They just can't find anything that happens to fit their needs because there's just limited action out there. So this is a sign of what's happening right now. We'll see what happens over the next couple months. Again, we are in that peak buying season. As we get into the later summer and into fall, I will update this report and I'll show you guys truly what inventory was doing. But a lot of these sellers are starting to sell their properties, and one would think if you have a 3% rate, why would you sell your house and go buy and get a 7.5% rate? Well, the reality is, I think two things. I think that sellers or even most consumers realize that we're probably never going to see 2 and 3% again. And there was a moment when rates spiked up from those 2s and 3s into the 6s and the 7s, where many said, I'm just going to wait for rates to get back down there. The reality of that is that was just a very abnormal time that we may never see again, or I don't want to say never, but for a very long time. A normal mortgage rate historically over all the years is about 7.25%. And we're pretty much where we are right now. So I think these sellers are going, I actually need a bigger home because we're having more kids, or my kids are all out, I need to downsize. Or a big issue that we're starting to see is consumer debt is at the highest that it's ever been in the history of consumer debt. So a lot of these homeowners that are sitting on a 3% interest rate, meanwhile, are stacking up all of their debt, student loans, credit cards at 25, 30%, car loans at historically high interest rates. All of this debt is stacking up and it's getting a little bit beyond their means. Many people are selling their homes. They have all of that equity in their house, right? Because their home values have gone up so much. They're selling their house, they're paying off all of their debt, and they're moving, whether they're downsizing or upgrading or moving out of state. A lot of them realize that we'll never see those low rates again, so we are starting to see sellers give up those low rates, which is a good sign for buyers that are looking for more inventory. Okay, so I want to go into conversations that I have a lot right now, and again, as we're in this peak buying season right now, if you're a buyer in this market, and this is very dependent on the market that you're in. Let me be very transparent around that. As many of you guys know, I work a few different markets. The main markets that I've worked out in the past 20 years are Southern California and Oregon. I'm personally licensed in 4 or 5 different states, but those are the places that the majority of the people that I help are in those places, but I can help people in other states as well. And so these markets, for what I see, are completely different, right? The Oregon market is a little bit smaller of a market, where the California market, more specifically that Southern California market, just a lot more population there. So it's hard to compare markets in all these different cities because it just depends on a lot of different factors. But one thing that you might see as a buyer, especially if you're looking at Redfin and Zillow, is you might start to see in some markets homes that have been on the market 30 days, 45 days, and then you start to see some price cuts. So a lot of these buyers are out there going, wait a minute, is the market crashing? Why are these homes cutting all of their prices? What is going on there? So I think there's a couple things that I wanted to unpack with you. One is affordability is tough for many people, especially at your entry-level price point right now. So these are buyers that are buying houses that probably don't have a big down payment. And payment is integral to them, right? It's got to fit within their budget, and at these high rates, it makes it very difficult. So if you're in that price point, sellers who maybe have priced their house too high have scared away some buyers. Buyers are very hesitant right now. That's the mindset of a buyer is, I want to buy, but man, these rates are high. It's got to be a perfect house. And if it doesn't fit all those boxes, buyers aren't really jumping into it as much as they normally do. So sellers now are going, oh man, I priced my house too high. Now I'm not appealing to a lot of buyers. I'm going to start doing some price cuts. Now I want to be clear that this doesn't mean that home values are coming down. It doesn't mean that the market is crashing. In order for the market to crash, we need to have the opposite. This is why the market crashed in 2008, was because we had way too many homes available for sale and not enough buyers. Now it's the opposite. We have way more buyers than we do available homes for sale. So a market crash is definitely not in the cards, and it's not going to happen. These price cuts are not an indication of a market crash by any means. They just need to get down to reality, maybe on what they think their house is worth, and then find a buyer that's willing to pay that price. So, I see this in a couple ways. One is, price cuts. In a normal market, 1/3 of the homes that are on the market will do a price cut. That is normal in the market. The other thing that I see from a buyer is, and Beny, they always ask Beny, when is a good time to do this? I said, well, if you want to look for a deal in this market in 2024, I recommend finding homes that have been on the market 60 plus days. Usually that's a seller at that point that is pretty motivated. Maybe they priced their house too high. Doesn't mean that anything is wrong with the house. It's just they scared some buyers away. And it gives you as an opportunity as a buyer to go in and negotiate. We've been able to help many buyers recently get pay less for the home. In some cases, we have the seller give our buyer credits. We use those credits to buy them, to get them a lower than market interest rate. Sometimes we use those credits and we're able to cover all of your closing costs as a buyer, which closing costs can be expensive. They're about 2 to 3% of whatever the sales price is. So I see this, especially a home that is doing price cuts, as a massive opportunity for a buyer right now. If you can financially make sense of the higher interest rates right now, it's a great time to buy. If you can't, and you just can't find the means based on these higher interest rates, it's not a good time for you to buy real estate. However, that doesn't mean that you put this away. You get a plan in place, you get ready, you find out what that interest rate needs to be for you to be a buyer, and you work with your lender, and you get a plan in place, and you're ready to go for when that happens. But for those that are in this market that can financially make sense of these temporary higher rates, I say temporary because they are, and can just get into home ownership, the one thing that doesn't change is the value of the house, and especially the payment, right? Unless you refinance. So you want to lock into the value of that house because as we know, real estate just goes up over time. The one thing that is temporary are definitely interest rates. So if interest rates drop, which many of us predict that they will in the next year or two, and you're able to financially get into a home right now, know that there's light at the end of the tunnel and there should be a great opportunity to lower that interest rate via a refinance into a payment that's going to save you potentially hundreds of dollars a month. So again, not a perfect market for everyone, but I do see a ton of opportunity of what's happening right now. Okay, so to end this, as I update you guys next month, the Fed is meeting again, right, in another 6 months from now. Many are predicting that if the Fed is going to start cutting the federal funds rate, that our best chance at that is at our next meeting next June. Now, it's not guaranteed. I would say right now there's probably a 30 to 50% chance that they're going to cut the interest rates. A lot can change between now and then, but this is why I do these market updates, to keep you guys in the loop, to expose you to opportunity, to let you know what's happening in this market right now so you can eloquently make the best decision for yourself and your family on when is the best time for you guys to buy real estate. Again, comment below. Let me know what you think. Do you think I'm right? Do you think I don't know what I'm talking about? I want to hear what you think. And if you like this stuff, please subscribe.